Welcome back, everybody, to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I am your host, Dr. Mike LoPiano. It's wonderful to see you all. Today, we are thinking about some of this price action that we saw pop up yesterday, what really drove this interesting move up to 33.50, and will we see some of this bullish price action continue? Will we see this trend continue intra-week? Does this potentially signal something greater for the stock? This is what we're going to put our focus on today as we take a look at our usual technical and options data. So for those of you who may be joining us for the first time, these discussions are based around daily analytic articles on GameStop that I post every day pre-market to my X page. If you're watching this on YouTube, you can find these linked down in the description of this video. If you're watching this on X, it is, of course, pinned to the top of my profile. So let's hop into this today, right? We're thinking about whether this bullish trend is in place to continue, right? Obviously, we're thinking about this, continuing to think about this within the context of these broader questions about whether we will see something like a requel of 2020 into 2021. There are some interesting technical factors that are popping up that do suggest we may be seeing, maybe not exactly the same thing, right? I mean, a lot of 2021, that late January price action was not only driven by some unique circumstances that had appeared in 2019 and 2020, but unique circumstances as well in terms of market mechanics combined with this very extraordinary euphoria driven by how viral GameStop went in late January 2021. So there are a lot of components in place. However, we are seeing some factors at a sort of drawn out level that do suggest we may be seeing in the near future something of an upward volatility character. So we'll look at some of those as well today. Obviously, this week, not quite approaching, right? We're getting close to the sort of rhyming week in 2021 where GameStop started to show exponential increases in price. We're not quite there, right? But it is important, I think, to keep in mind. Certainly, I'm keeping this in mind as I'm going into my trades, as I'm thinking about how to balance my positions going into the second half of this month, going into January OPEX, that these types of dates are looming. So it's something I'm keeping in mind, though I'm also keeping in mind the fact that, you know, they will not present themselves until the appointed time, right? So also not trying to get ahead of myself in terms of what I'm anticipating. So as we review, thinking about, right, what we were working from yesterday, yesterday's price action seems to have been driven in large part by a number of large Chicago exchange trades. So, trades in excess of $25 million coming at the tape rate. So at 936. So it does look like this sort of downward price action down to about 30.75 was driven by the delivery, right? This is a lit exchange. This was a lit trade. Many hundreds of thousands of shares had to be purchased. It does look like that was assessed in the early part of the day, which was followed by some bearish options trades. Interestingly, right, largely as a result, it seems, of this trade, right, of this trade coming in, we didn't get crazy upward. Well, we did move from about 31.35, so kind of closing price on Friday, something like that, close to closing price Friday, a little bit below it, up to 32. But I mean, as you can see, this seems to have brought about kind of a disproportionate jump in our implied volatility. Okay, yes, normally we do see a jump in implied volatility between Fridays and Mondays, largely as the result of large gamma exposure expiries, so large gamma expiries, right? We had a lot of call gamma that gets accumulated, that gets wiped off the board, and that has the effect of building in increased volatility into our trading landscape, right? So as contracts come off the board, delta hedging and gamma hedging is no longer required for those contracts. The total number of contracts that are on the board decreases, and that means that the strength of market maker hedging when we have these decent sized gamma expiries is weakened. And weakened market maker hedging generally tends to build in some more volatility comparative to levels that had been seen prior to that gamma expiry. So part of this jump here early in the week is from that, but I think perhaps some of it is built into the fact that that this very large order came through. With the right, it came in at the bid. It was about 750,000 shares or so at the bid that were assessed over this period, and as a result of the very large increase here in implied volatility, there were a lot of IV sales. Right, so typically when short call dealers are looking for good entry points, they are looking for spikes in volatility, not just spikes in price. And a lot of that has to do, right, as you sort of get closer to the money, if you're shorting in the money contracts, then volatility is going to be less important. That's going to be more of a directional move, since you are anticipating largely you're going to profit from changes in intrinsic value with respect, let's say, to that short call or that short put, given that the more in the money a contract is, the greater proportion of its total value is going to be intrinsic value, that is value with respect, realized value with respect to the contemporary valuation of the underlying shares. So, however, generally options sellers target out of the money calls, target out of the money puts rather than in the money, for the reason that most of the value there is in extrinsic value. And the more extrinsic value is in a contract and the less intrinsic value, the greater the probability that that contract is going to lose value over time and is eventually going to expire worthless. So those are highly, and out of the money short options trade is a high probability trade, number one, but is a trade that is targeting an expected decrease in volatility within a set time frame. So it works very similar to long shares in that regard, which is a bit counterintuitive, right? Most retail traders go into the market, they think, a long option, that's long, that's going to behave and target the same market dynamics that having a long share would, because they're long in terms of your holding orientation. However, a short call is in many cases targeting some of the same underlying factors that a long share would. One of those in particular is volatility. So short call sales, you'll see when we have spikes like this, very quick IV spikes, that very often these are going to be followed by short call sales rather than, not necessarily long put sales. We don't see a lot of long put, or I should say long put purchases on GameStop. We don't see a lot of that, but we do see a heavy amount of short call sales in that they target this volatility. So that's what we saw early on. Around 1:25 p.m., so right around here, we did see another very large Chicago exchange trade come in, which looks to have been responsible for this very explosive price action that we saw at around 2:10 p.m. Eastern time. And this largely, as it came in, it was a high volume of shares again that came in. It also triggered a fair amount of market maker gamma hedging that ran the gamma ramp built into our gamma hedging landscape that I spoke about in yesterday's post, namely that we had this high concentration of call gamma exposure between 32 and 33, but that I had expected, if we were going to see this sort of bullish scenario unfold in the week, that we would see it cap out at about 33.50. So I said, I saw from our technicals yesterday, right, if we go down to our 4-hour chart, as we go down to our 4-hour chart, right, I said, okay, well, you know, we sort of opened the day right around here at the midline of this this still bullish but regression subchannel. It's actually really starting to closely align with our macro channel. You know, we were in a position where we could have broken up, but that basically what I saw configured in our technicals here were okay, at minimum, right, we kind of break down here. We go to the resistance line of the sub, or the support line of the sub channel, which is overlying our 104-hour moving average, which is consummate with the 20-day moving average. Or we could move up and test this resistance line of this sub channel. And then I thought that this move would materialize over the Monday, Tuesday period if we were going to look at this bullish scenario. We got that full move realized up to 33.50. That also happened to be where a fair amount of our call gamma dominant territory, our call gamma accumulation, and therefore gamma hedging ran out yesterday. So we reversed at that point and then settled right in the middle of that 32-33 range, which does look, if we have a more or less neutral day heading into today, that does look like it's going to serve as a pretty stable trading range. But I do have some reasons to suspect that we could see some continuation of this particular trend. So first off, we did see this 33.50 move realize very early in the day. I should say very early in the week. If it had taken until Tuesday or maybe even later, I would say that that probably would represent a pretty confident high on the week. And we could expect, right, with GameStop having this, right, with market closure on Thursday in honor of mourning and National Day of Mourning for the late Jimmy Carter, President Jimmy Carter, that this would likely prevent much bullishness into the end of the week, barring some sort of unforeseen major settlement event that may induce some heavy buy pressure behind the scenes, right? Right, GameStop would move into something, right? A lot of these in the money, or I should say out of the money contracts, especially how many calls we have at 35, how many calls we have at 33, and now we started to see some accumulate at 34 as well, that these then would enter into a negative charm regime. So there'd be this downward pressure on the stock while in the middle of this range. We do have a lot more shares. We have up to 1 million shares again, short shares available to borrow have come onto the board. So these could be used tactically and in some decent force to be able to push the price down. So still keeping that on the radar, still thinking about that heading into the remainder of the week here. But it is early enough that I think there is some room to see continued upward continuation here. And that is largely the result of taking a look here at our RSI levels. As we've seen over the past, what is this going back to? Yeah, just after we kind of stabilized in here following that Thanksgiving short off post earnings, we reclaimed this more or less RSI neutral as a support line within our trend, which matches what we were seeing in the first part of this trend, right? The sort of 2 weeks approaching earnings were some deviation from this pattern. But after earnings, a week after earnings, or even actually really kind of at the tail end, yeah, the exact week following earnings, we resumed using RSI neutral like an oversold level. So RSI values below RSI neutral, meaning 50, have more or less functioned for the market, it seems, as oversold signals, with RSI overbought being an intratrend overbought. So RSI values in excess of 70. We saw that play out several times in the early part of this trend, right? So RSI overbought down to just below 50 and then back up above 70, right? We settled back down again, we continued to stay down until we got down below RSI 50 again, reversed to overbought, down close to 50, reversed to overbought. And then we had the Thanksgiving trend, which really disrupted this for 2 weeks into earnings, and then back, right, once we established, okay, a support here, back to RSI overbought, back sub 50, back to RSI overbought, back sub 50. We haven't yet reached overbought. We are slightly above, actually, it looks right now at the time that I took this screen, we're at about 57, but I think a little bit later. Where are we now? Yeah, at about 60.5, which is what I mentioned in the sum up of the article. So we're about 60.5, which means we do have a bit more room to run. Now, not a crazy amount of room to run, but it does look like since we reached that 33.50 mark early enough in the week, I could see continuation to about 34, maybe into that 34.50 area, based especially on this RSI value. So I'll come back to some of our technicals in the broader frame in a bit, but I did want to point out how these levels also show up in our options landscape, right? So looking at a favorable put to call GEX ratio, so very bullish in terms of the levels we're seeing, the amount of call GEX on the board that is call gamma exposure versus put gamma exposure. So it actually went down versus yesterday, even though we did have some puts come on the board. Our price movement has really decreased the strength, decreased the amount of gamma that corresponds to those put positions, whereas call gamma has increased relative to new call positions that have been opened, and how gamma values have appreciated relative, or I should say, as a result of our price action yesterday, our bullish price action yesterday. And we can see that reflected here. So let me see if I can zoom in a bit. It's a little bit bigger. Whoops. Yeah, right. So we can see this upper. And so here on the left these are our gamma values from pre-market yesterday. This is our call gamma exposure. Still very positive, but of course weaker below 32. It's actually, well, it weakened up a bit. There's not as much gamma there, of course, because we're significantly above this level. It doesn't necessarily reflect that there are fewer calls there. It's just that gamma has been realized, right? That gamma exposure has now been hedged. Market makers are no longer exposed to those gamma values because those contracts are in the money. A lot of the gamma present at those strikes has now been hedged. So market makers have shares that now correspond to those negative gamma, that negative gamma on their books, right? Which is, or I should say positive gamma, which pertains to the rate of change in delta. So negative delta on their books, right? So they're offsetting that. The middle of our range, of course, we have 33 just because it's about to go in the money. Its gamma values are now highest. So we have a spike in the amount of total gamma, a significant increase in the amount of total gamma at that strike. It's increased slightly at 32, largely because the gamma values were enough above 32 that the gamma values at that strike have gone down a little bit. But because of added new contracts, the total gamma and the net call gamma at that strike has increased marginally. So we can see that it's moved up a bit. We can see gamma values increase here at 34, a bit at 33.50. So we definitely have the potential, if we are going to get some bullishness, we can grind up into this area a bit. However, as of right now, based on what we're looking at, I would be inclined to expect a continued run earlier in the week to run out of momentum at 34.50 in this hedging dead zone, right? There isn't a lot of gamma here, period. So the continued upward force as contracts move in the money, as 34.50 would move in the money, there's not a lot of supportive market maker hedging at that level that would continue a run. And so traders know that dynamic is in place. And so when the price moves in there, rather than continue to bet on momentum, which, I mean, the probability that momentum will continue at this point is lower than it would be, say, in this 32 to 33 range, if we do end up moving up because of some major buying factors, they will start to bet on a reverse because there is a lot more value to be realized by getting gamma hedging going in the other way, by having a bearish momentum build up. So that's something that I could see occurring under normal conditions. So we get some buying pressure. It can take us up into this region. I would see us running out between 34 and 35, unless we have some reason, unless the market has some reason to expect, some huge anomaly in terms of what's going on with ETFs or covering or settlement or something. I don't know why something like that would happen today. I don't have eyes on it. But if something does, or there's some sort of catalyst via the company or Roaring Kitty or something like that, then maybe we see the options market dogpile on more bullish momentum to kind of carry us up there. But again, even in something like that, we haven't seen those types of events violate our technical structure, kind of break out of our paradigm. And a lot of that has to do with kind of reactive volatility sales to whenever that does occur, since it's so tantalizing, right? Brokers, market makers jack up IV, which then really incentivizes IV sellers in the market to go and just kind of dump short calls on that position. So So it is possible, but again, still measured, I think, early in the week. We'll have to see what happens. We do have Ultimator wrote about this today. He's pretty good about reminding people about when computer share recurring buys happen. We do have some of that supposedly coming per Ultimator. He is my source. Around either I think it's 10:45 or 11:45. There are these two windows where sometimes that pops up. Depends on the day, depends on the month, maybe. So that may prove to be a small. It's not. I mean, it's not a huge catalyst, but it may be something that the options market also knows is happening, and may play that to continue our bullish trend up into that 34 area. But I'm not seeing anything. I haven't found anything yet that would suggest that we would continue much beyond that level at this point. Okay, but what about maybe a little bit deeper? And there's some other things I wanted to point out to us with respect to our weekly charts. So this is something in particular that I know Richard Newton has been looking at some of these weekly charts, especially going back to 2013. So some of Richard's recent videos, which are very good, I really highly recommend if you don't follow Richard to check out his work. He's done really some amazing work on the ETF side of things. He's done a lot of great case studies going back, sort of looking at his own data and using that to validate some of the claims, test some of the claims that were in otherwise categories 42s, big DD as it's called, thinking about settlement periods and Rec 68, margin call extension windows, things like this. So I would recommend you go check that out. But in terms of my own sort of digging, looking at our technicals, one thing that I do want to call our attention to is the fact that we do have this particular technical element, which is popping up currently, that does look similar to what we saw back in 2020, 2021, and in some ways to 2012, 2013, which was the first GameStop short squeeze. Supposedly, and this is something I learned from Richard, supposedly it was this event back in 2012 and 2013 that put GameStop on Roaring Kitty's radar, such that he was in a position to notice early a lot of these factors that were going on in 2019 and 2020. So he was very much looking at the stock. GameStop had been on his watch list for a while. So thanks very much to Richard for pointing that out. But this particular element that I noticed, and I've been writing about kind of off and on over the past few weeks, has been the fact that we are logging weekly candles, all of which close above our 200-week moving average, or 200-week simple moving average. We are currently in the midst of our 7th consecutive week trading and closing above the 200-week moving average. That has happened so far as I have found only 2 other times in GameStop's history, at least in the past, for the past 12 years. So for example, most conspicuously in 2020, 2021, leading up to the first exponential move in GameStop in 2021, GameStop traded for, you guessed it, 1, 2, 3, 4, 5, 6, 7 consecutive weeks above the 200-week moving average, and in its 8th week exploded exponentially following the news of Ryan Cohen's joining of the board, yes, but only thereafter on the 13th, right? Ryan Cohen announced this on January 10th. Roaring Kitty, of course, was very excited. Keith Gill talked about this on his live stream on January 11th, where that picture on today's article is taken from. But it was not until January 13th that it seems as though a number of different settlement windows with respect to ETF FTDs and perhaps some margin calls with Rec 68 extensions overlapped based on a lot of the buying that had occurred earlier in the year. And this is what resulted in the first major exponential move in GameStop's price. First, 120% move on January 13th, followed by another 60 or 65% move the following day on January 14th. So this was something that occurred in the historicals in GameStop's price action. And it occurred after that 7th week when the 20-week moving average crossed above the 200-week moving average. We saw something like this as well, actually, in 2012 and 2013. Not quite that 7 weeks, but we did see an extended period between 2012 and 2013, heading into January, right, coming out of the year, some bullishness coming out of the year following, starting with the Q2 earnings report, and then really being propelled upward by the Q3 earnings report, settled out a little bit, but stayed above the 200-week moving average. And then shortly before the end of 2012, the last week of December, we had the 20-week moving average cross above the 200-week moving average. And then GameStop stayed above the 200-week moving average. We had all of our moving averages stack on top of each other, what Richard likes to call this rainbow formation, that Roaring Kitty also points out in his charts. And this began essentially a year-long slow squeeze on GameStop. So not quite what we saw with all of this euphoria, all of this sort of when GameStop went viral in 2021. But we did see some really tremendous price action. Right towards the end of the year, GameStop moved over a 100% move over the full course of the year. So it began the year at around $6, trading slightly below $6, over 100% move, maybe about 150% move by the next, it looks like about November, mid-November. So, you know, maybe this is a signal, right? Both of these suggest, right, this type of price movement, end of the year into the beginning of the year, trading above the 200-week moving average. As we can see on our own weekly chart currently, we do have the 20-week moving average is getting very close to the 200-week. If we see that 20-week move over the 200-week, that may be an extremely bullish signal. That certainly looks bullish from a historical perspective to me. That certainly looks like the type of price action that is indicative of the bullish momentum across a longer time frame that institutions may be looking for to exploit and profit off of some much longer and much deeper penetrating upward price movement. So that's something I'm keeping my eye on. Certainly something that looks great, right? Even as I get into the, it can be easy to get lost in the weeds looking at our day-to-day price action, looking at, you know, this 4-hour chart or daily charts or things like that. But certainly zooming out into these weekly timeframes does suggest, right, you know, maybe we just kind of slowly move up for the whole year to like 60 or something, right? It doesn't necessarily have to be a, you know, 3,000% move up to like, you know, $500 in order for it to be extremely profitable for shareholders, right? And, you know, certainly looking at that 2012, 2013 chart, I mean, there wasn't even much correction there at all besides, you know, kind of earnings periods. Things got a little wonky. But besides that, right, pretty bullish. So maybe we get something like that, right? Requel doesn't necessarily have to mean a requel of 2021 beat for beat. It could be a requel of some similar pattern earlier. Maybe, in fact, the reason why Roaring Kitty was in a position to profit off of 2021 was because he had already closely studied what had occurred in 2012 and 2013. Certainly, based on his own technical analysis of the stock, he was in a very good position and did set himself up very well heading into 2021. So, you know, just throwing this out there to give you guys an idea of maybe some alternative formations, some alternative price movement patterns that could develop out of this bullish setup as we move later into January. And even if we don't see a 2021 type movement over the final 2 weeks of January, is not going to continue in some way. So that's what I'm thinking about today. Certainly have a good outlook heading into the rest of the week. Yeah, numbers look, our movement looks good, right? Options data looks good. We have a lot to certainly look favorably on. With that being said, right, this bullishness this week may not mean that, hey, we're going to definitely explode. Oh my gosh, it's Moaz, something like that. But at the same time, the bullishness we are seeing on some of these broader timeframes does bode well heading into the rest of 2025. So thanks very much, everyone, for watching and listening. Good luck out there today. And we will see you for tomorrow's breakdown. Yeah, thanks very much. Take care.